Hey guys, it's me again, Manny Mine. Welcome back to my channel. Today, let's talk about the 7 things to do before direct investing. When stock market is down, we often hear from our friends, our colleagues, television, any platform, encouraging us or telling us to invest in the stock market, or they said investing is good now because prices goes down. They said market has been bargained. Imagine S&P 500 had increased to 46 and 70% from its low level in 2010 at 1,044.10 price to 3,380.16 in February 2020. However, the gain has been affected by the crazy market downturn due to coronavirus this year. It down to negative 24%, whereas price went down to 2,304 and 90. Stock market comes first on our mind for this kind of investing. The question is, are we in or out? So before we answer that question, let us know first the 7 things to do before direct investing. Number 1, decide to invest now. The best time is today. The earlier start, the better, because investment needs time, the amount of savings or the amount of money you had invested to, and the rate of return or interest rates. Imagine leaving your money at the bank having only a 1% interest rate. Using the rule of 72, it can duplicate or double up in 72 years. Wow! What can it give to you then? Will your retirement be comfortable? I don't think so. Speaking about retirement, let us use the rule of 4%, which states that you will access 4% of your total investment. Reaching age of retirement, let's say age of 67, you will access 4% of your total investment or investment value without risking of lapsing or leaving it out. It's simple, guys. You just have to divide your estimated income or estimated amount of money needed for your cost of living on your retirement. So let's say that you need $50,000. Just divide 4%, that $50,000 by 4%, it will equal to approximate value of $1,250,000. The rule is based on 7% rate of return, less 3% inflation rate being benchmarked to S&P 500. So retiring at the age of 67, then if your age is 30 today, you need to have a monthly investment of $592.76. But if you were at your 20s or 20 years old, then you need to save only $283.32 to get 1.2 and 50 million at age of 67. So millennials, see the relationship between time, rate of return, and your savings? So start as early as you can. Exploit that power of time that you have, because when you reach age 45, reach 40 or 50, and then you have to invest more. So start when you're young. Number 2, have an emergency fund of at least 3 to 6 months. Yes, I'm serious in this. Prepare for rainy days. In case you lose your job or your business had slowed down during financial crisis or any pandemic, you won't risk selling your investment at lower price just to survive. Remember that stock market is very volatile. It may go down in no time. You can't afford your emotion to ruin your guys, to ruin your investment, to ruin your financial status. because you need to survive. Plus any corresponding tax consequences, transactional charges such as commissions or other fees. So guys, just invest that money you don't need today, or risk that money you can afford to lose. Got it? Number 3, know who you are. Oh, you don't know who you are? Guys, relax. It relates to your risk profile. What kind of investor are you? Are you conservative or aggressive? Conservative meaning your risk tolerance is low. You have that risk-averse attitude which you can't afford to lose significant amount of money in no time. Accordingly, stock market investing isn't ideal to those conservative investors. You know what? Because these people can be ruined by their emotions. These people cannot control their emotions when their value, the market value of their stock price goes down by 10% or 5%. They become crazy. Oh, what happened to my money? You would say like that, okay? However, they can still do that through the guidance of a financial advisor or by selecting blue chip stocks, though it's quite expensive. Meanwhile, aggressive persons are those investors who can take the pain of their stomach, which means that they can afford to lose a significant volume of their investment and offset or in a trade-off for a higher return. So the higher the risk, the higher the return, right? Number 4, set your goal. So what is the purpose of your investing? So it is short-term or long-term. It can also be in a way that what type of investor are you? Are you a short-term trader or a long-term investor? It is important, guys, because it will determine when or what is the timing where you're going to sell your stocks or ownership of that company. Further, investing in short-term basis exposes you to more risk of losing your money. In addition to your effort in monitoring and researching the factors which influence price movements on the stock market. Deciding your goal to be long-term is quite rewarding. Stock market has at least 10-year horizon before your investment could earn higher returns. Yes, nobody knows when would the stock price goes up because there's a lot of factors to determine that. But based on past happenings or past experiences, it says that at least we have to leave our money on a 10-year term basis. In the event stock market is down, don't be rattled. Stay calm instead. Build your portfolio by buying more stocks, buying more shares in that company. Okay? You aren't losing anything just yet. It's just a paper loss. Okay? So don't be afraid. Invest more and wait. If you can wait for your love to come, then you can wait for your money to grow. Number 5, consider tax implications. So what I mean, here in Canada, we have 3 options to do our direct investing. So we have personal account, tax-free savings account, unregistered retirement savings. Guys, why? Why I mention this and why I put it as number 5 things to do? Maybe it will not be applicable to those people outside Canada, okay? Because actually, if you can do things wherein you can avoid, say, paying taxes, do it. Because tax deferral is very good for everyone. Any deferral is the best for us. So avail it. Because you don't have to pay tax, therefore, no tax, it means you have more money to invest. And if you have more money to invest and then you have more money to grow, you don't like more money? Me? I love to have a lot of money to grow in a tax-free environment. You noted though, guys, that investing in the United States, if you receive any dividends, it is subject to a 15% withholding tax. So personally, I choose RRSP on my first investment here in Canada in the stock market for tax planning and long-term purposes. Okay, because I do investing for my retirement, not for my living. But for beginners, you can use tax-free savings account because it is straightforward. However, we'll be having a separate episode on TFSA and RRSP, elaborating its pros and cons. So don't forget to subscribe and hit that notification bell to not miss it. Number 6, choosing the right brokerage. Having the right platform, guys, on your investing is vital. These are one of the brokerage that I did consider since I came into Canada. Curious Trade, World Simple, Scotia Trade, and TD Direct Investing. Choosing one of these four, there are a lot also. You can do your research. Choosing one of these is very important. Why I say that? Because here, you have to determine which one could give you convenience and which one could provide you any platform where you are comfortable to go with. Like me, I'm comfortable doing my stuff on my desktop, on my laptop too, and also on my mobile. But I'm more doing it on my desktop because that every time I buy stocks or sell stocks, I will update it on my own monitoring. In addition to that, also consider your investing directions. Meaning, know if you will only invest here in Canada or you also want to invest in the United States of America, because there are platforms that will not allow you to invest in the United States. So that means only here in Canada. Also consider the fees, the required investment, the required trading, and so much more. So we can also have to discuss that one by one and helping you choose the right brokerage. For the meantime, I will put the link of these brokerage companies in the description below and you can have your own research. Number 7, the last but is not the least, setting target selling price. After you had decided the points above, the last thing to do, guys, is to set your target selling price. Yeah! Have it. Let's say you want a target selling price of 30% or 20%. Or if you have the gut feeling that this company would be like Tesla, then wait until it will increase to $500 share price or $300 per share price. Or if that company, in accordance to your research or your gut feeling that it could be the next Amazon, and then wait until it will increase into a 1000% or at least 500%. The key here is you have to set a target price because nobody, like I said earlier, knows when the price would goes up because it depends on the demand and supply. It also depends on any economic factors. It also depends on the operating capacity of that company. How about its working capital? How about its financial leverages? There are a lot of factors. So monitor on a daily basis or at least twice a week or thrice a week if your stock price reached to your designated price level and then sell your stocks. If it's not yet there, and then held it long term. That's the basic of direct investing. So guys, set the price, aim for more, but please don't be too greedy. Greediness is a mortal sin and it will never be okay. So to answer our question earlier, are we in or out? It depends on you folks. But I want to leave you this one. When you're going to start savings for your retirement, where are you going to completely decide the destiny of yourself? Remember, at this time, we need to be money-minded. Since we're talking about pricing for our stock price, and actually it is the best topic or the best point I reached to you today, I will have a follow-up video next week. Remember that, next week, to discuss the factors or the things that affect the movements of stock prices. So the basic things. So don't miss it. Okay? So don't forget to subscribe and hit that notification bell. If you also want to know on how to start or kicking off your investing, then I will encourage you to see my video on a personal finance cash budgeting, so you will also know on how to set aside money so you can finally kick off your butt to start direct investing. See you guys!